Hey everyone, welcome to Midnight Market. This is where we slow things down and take a quieter look at what's happening in the markets. Most finance videos shout at you, this one whispers. So take a breath, settle in, and let's talk about something fascinating, how companies go public. And specifically, how SoFi, one of the most talked about fintechs in the market, did it a little differently. Before we talk about SoFi, let's start with the basics. What exactly is an IPO? An IPO, or initial public offering, is how a private company becomes public for the first time. Think of it like this. You've built a company, maybe with help from friends, investors, or venture capital. It's growing fast, and now you want to raise bigger money and let everyday investors own a piece of what you've built. That's when you go public. To do that, the company works with big investment banks, called underwriters, who help figure out how much the company is worth, how many shares to sell, and at what price. Then the leadership team goes on what's called a roadshow, a kind of investor tour, where they tell the company's story and try to build excitement before the big day. Once that's done, the company lists its shares on an exchange, like the NASDAQ or the New York Stock Exchange. It's a huge moment. It gives the company new funding to grow, but it also puts it under the spotlight. Every quarter, every decision, every number, all of it becomes public. And the process isn't quick or cheap. There are lawyers, bankers, regulators, and months of preparation before the first trade ever happens. Now, that's the traditional way to go public. But around 2020 and 2021, something new started trending. And that was the SPAC. Stands for Special Purpose Acquisition Company. A SPAC is kind of like a blank check company. It doesn't make or sell anything. It's just a pool of investor money that's already public, waiting to find a private company to merge with. When they find one, the two companies join together, and that private company becomes public instantly. It's faster, it's simpler. And during the pandemic boom, it became extremely popular. Celebrities, athletes, hedge funds, everyone seemed to have a SPAC. Was seen as a shortcut to the market. But shortcuts can be risky. When too many unproven companies went public all at once, investors started realizing that not all of them were ready for prime time. By 2022, many SPAC stocks had fallen well below their launch prices. And that brings us to SoFi. SoFi, which stands for social finance, started as a student loan refinancing company. The idea was simple: help young professionals manage debt smarter and faster using technology. Over time, SoFi grew into something much bigger, became a full digital bank, offering checking, savings, loans, investing, and even credit cards. When SoFi decided to go public in 2021, it could have done a traditional IPO, but instead, it took the SPAC route, merging with one run by Chamath Palihapitiya, the same investor behind Virgin Galactic and Clover Health. The deal valued SoFi at about $8.5 billion. At first, investors loved it. Fintech was hot, interest rates were low, and the idea of a modern, tech-driven bank felt fresh. The stock traded above $20 for a while. But as interest rates climbed and the SPAC bubble deflated, SoFi's share price dropped sharply, losing more than 75% from its highs and falling under $5 at one point. Fast forward to now, October 2025. SoFi closed at $26.54, up slightly after hours to $26.74. But that rise isn't luck. It's the result of real progress. SoFi has now reached profitability, which is rare for a fintech company at this stage. They've grown deposits to over $20 billion, built a user base of more than 7 million members, and expanded into new areas like mortgages and small business banking. Their CEO, Anthony Noto, who used to be the CFO at Twitter and an executive at Goldman Sachs, has been focused on building a real, sustainable bank, not just chasing hype, and it's starting to show. Even institutional investors are taking notice again. Recently, Heartline Investment Corporation increased its position in SoFi by almost 4,000%, now holding over 500,000 shares, worth around $9.5 million. That's not a massive number for Wall Street, but the move itself sends a signal. When big investors start quietly adding, it usually means they see long-term potential. SoFi's story is a reminder of what it really takes to grow. A few years ago, it was just a student loan app. Then it became a SPAC success story. Now, it's turning into a legitimate, profitable bank with a tech edge. SPACs can open doors, but only discipline and leadership keep those doors open. And SoFi's journey shows what that evolution looks like in real time. So, what do you think? Do you own SoFi stock? Would you buy it now or wait for the next dip? I'd love to know your thoughts. Leave a comment or message me what you think about SoFi's future. Thanks for listening tonight. Sleep well, stay curious, and remember, the market never sleeps, but you should. I'll see you tomorrow, right here at Midnight Market.